All right, so this is module 8, and what we are now doing is moving into the formulation phase of strategy. So you've done the research, you're working your way down, you've done the external assessment, the internal assessment, your understanding of the brand, what the competitive advantages, you know how you want to position as a differentiated or cost leadership or blue ocean brand. Are you going to innovate and focus on new innovation, new business models, or are you really focused on vertical integration and more so diversification? So they all seem to be linked in some form or fashion. So again, this is the list. When you do Lowe's, I'm looking for 3 strategies for your group project. I'm only looking for 2. So, and what's going to drive strategy is your research. What is the research telling you that you need to do? So again, today we'll be focused on where you see the bold lines there. So let's review what corporate level strategy is. So these are ultimately bets. I like to use the word bet because a bet is you're placing money down and you're making a decision with the likelihood of getting a return on your invested capital. So you're ultimately trying to create a competitive advantage or to strengthen and deepen the moat, keep it wide and deep, and you're selecting and managing a different group of industries and or businesses, and we call that the portfolio, and operating them successfully. And so again, usually vertical integration, diversification, and geographic scope, but it might not be limited to that. So the first important point is when we think about diversification, we actually need to think about the business model. And so every organization has a very specific business model, and the business model, of course, is how you're positioned, who your customers are, the product, of course, or service that they want to buy. Are you able to price it in a way that creates sustainable profit? Who are you hiring? What type of talent do you need? What type of capabilities do you need? How do you want the culture to be? And then within the culture, that as the world changes, you need to make sure that you're navigating that. So 2 of the external videos that I had in podcast, Milk Bar, the podcast on Christina Tosi, and then there's a video that I want you to listen to. So every one of these brands, WeWork, Milk Bar, In-N-Out Burger, Airbnb, Apple Computer, each one of them has a very unique business model. Even when you look at Apple and then you compare Apple to Samsung, yeah, sure, they make many similar products, but Samsung hasn't jumped into streaming video. Samsung makes a lot of other appliances that Apple has chosen not to get into. So Samsung's portfolio is going to be different than Apple's, but the whole idea, around the business models, it has to generate returns. It has to generate profit so you can reinvest back in the business. And so the idea is that you're looking for a sustainable way to scale your business. So WeWork came out with this idea that it had about co-working space. Other people were doing it, and they decided to do it in a very different way. They're able to go out and pitch investors, and investors bought their pitch, but they came to a point where they were diversifying. They were buying stuff that they probably shouldn't have bought. The culture was very undisciplined. The whole idea around their CEO, he went into a state of hubris and arrogance. And so WeWork, of course, he was fired. WeWork is still here. and it's going to go public through a SPAC if it hasn't already. So it's a model that still hasn't found its way. Milk Bar started as these brick and mortar bakeries, and was able to pivot during COVID, went online. They're now, of course, selling CPG products. They've extended into doing ice cream now. So Milk Bar is doing really well. It's a very complicated business model, but they're doing well. Of course, you'll read about In-N-Out Burger, which has made the decision to not grow too fast. A family started it, and a young woman in her 30s is the CEO who's running it. So there's a bunch of really good stuff out there on YouTube about In-N-Out Burger, Airbnb. They haven't consistently found a way to generate a return. And then, of course, Apple, has done extremely well over the past several decades. So every one of these has to think about how they're going to diversify. So Milk Bar started as brick and mortar dairy, then they went out to the internet, and then they continued to add new products to their business model. Where In-N-Out Burger's only diversifying from a geographic standpoint. They've got a very, very tight business model, similar to Five Guys and similar to Chick-fil-A. But I would say In-N-Out Burger is even tougher in terms of how they want to scale their business. So when we talk about diversification, it's the process of allocating capital. And that's the bottom line is we've got a certain amount of profit left over at the end of the year. And how do we want to use that profit? Do we want to give it back to our shareholders, to our investors, or do we want to keep some of it and put it back into the business to grow the business? In my old world at UCrops, we had a formula for how we wanted to grow the business. And that was 50% of our pre-tax profit every year went back into the business to be used to make bets, to make decisions, to ultimately strengthen our competitive position. And as wonderful as UCrops was, the business model, though, didn't travel well because we were closed on Sunday and we didn't sell beer or wine. And in the supermarket industry, Sunday is really important, and beer or wine, selling it is really important. So it's a way to allocate capital in a way that reduces the exposure to any one particular asset or risk. So at the end of the day, diversification, yes, it's about growth, but it's about managing risk. And okay, you probably got it. Don't put your eggs all in one basket. And so when we talk about diversification, though, it could include diversifying your products. So let's go back to Apple. They started with desktop computer, then they diversified into portable, then music devices, and then a smartphone, and then a tablet, and earbuds, and headphones, and then streaming audio, and now streaming video, and et cetera, et cetera. And so the iPhone, though, has been really the cash cow for them over the years. But they're able to make money in those other areas as well. Don't have a clue yet if they're making money in the streaming video section. I would think not. But, maybe they are. I haven't dug into their 10K that well. So diversification can help a brand by providing economies of scale, which will help reduce costs. And remember, economies of scale essentially is where, let's say you have 5 stores in a region, and then you add another 5, and by now having 10, you're able to create economies of scale for your central accounting department, for your IT department, for if you're going to put TV commercials or radio commercials or whatever. Economies of scope are that you're going to be able to leverage, in Apple's case, their innovation culture. You're going to be able to leverage that and bring it over and leverage that to help not only innovate computers, but again, smartphones, tablets, et cetera, and or both. And so it's a really good thing when you diversify. Now you can over diversify. You can get a little too cocky, and that's what happened to Uber. They started this business where they'll bring kittens to you you know, to if you want to get hugged. And I mean, I've got 4 cats. I love cats, but you know, and they got into the autonomous vehicles. They spent billions of dollars moving into autonomous. They developed a relationship with Carnegie Mellon up in Pittsburgh, and um, just did some real nasty stuff to Carnegie Mellon, as far as I'm concerned. You know, hired away 50 of their engineers, and they really don't have anything to show for it right now. So all those bets on the autonomous side didn't amount to anything, and they actually have sold off that division. That's one of the things that the new CEO did when the old CEO was fired. So if you think about Amazon, here are the Amazon sub brands, and I'm sure there are a lot more. These are the ones. I picked these up in 20, but we're 2 years later now, so I couldn't find an updated. But you see the Whole Foods right there, Woot, Zappos, Ring. You know, you have the Mojo, the Audible, and Fabric, and Shop Bop, and so they have really diversified. But if you were to break it down and try to figure out what are, you know, which of these, what portfolio is generating the most profit for them, revenue and or profit. You know, I'm sure Zappos is profitable. I'm sure Woot is profitable, but it's really their Amazon Web Services, AWS, that seems to be doing the best for them. At least that's what I hear. Sometimes firms like Amazon won't always break down their revenue and or profit by business unit. And so when we think about diversification, again, one of the things that brands have to figure out is, are all the brands going to be named after the master brand? So you see Amazon Web Services, Amazon Music, Amazon Advertising, Amazon Drive, Amazon Fresh, you know, Amazon Warehouse. But they allow other sub brands to have their own identity: Woot, Zappos, Ring, Whole Foods Market. Now, most people by now, I would think, I don't know, what do you think, 50, 60% know that Whole Foods is owned by Amazon, and maybe I'm wrong on that. So it's a brand that chooses to have what we call a hybrid approach to naming, meaning that not all the brands are going to carry the Amazon name. If all the sub brands carried the Amazon name, that would be called a branded house. If none of the brands carry the Amazon name, that's called a house of brands. And of course, Amazon is hybrid, which is the other third approach. Here's Alphabet. Alphabet, of course, is a corporate entity for Google. And under Google, and Google, I think, is still generating probably 95% of the revenue and profit. But they started Calico, Nest, all Sidewalk Labs, which is a cool company. Take a look at Sidewalk Labs sometimes. All these sub brands, Waymo is their autonomous vehicle software program, but Google's still the brand that's generating the lion's share of the profit for the business. So when the two co-founders started Alphabet, it really was Berkshire Hathaway, I read, that inspired them to come up with a new corporate structure that would drive growth. So we'll see, you know, and my opinion is, we'll talk more about Walmart later, but Walmart is in a similar position that, you know, the name Walmart, low price and convenience, somewhat puts shackles on them for be able to bust out of that. Again, we'll also see that they're buying up these little high-end online brands, but no one knows that they're doing it. So types of diversification, product diversification. So this, again, when you think about Apple, or you think about Milk Bar, and this is Milk Bar, you know, having cakes and cookies and other type dessert items, and now they're moving into dairy, and of course with their with their ice cream, and you can get ice cream at Whole Foods. So Mopart's done a really good job with that level of diversification. Oh, by the way, I'm sure some of you have heard about Little Debbie, which is they've always made these little donuts and pastries and stuff. They're now offering a ice cream product as well. Can be geographic diversification, so you're moving into different markets geographically, whether it's you're located here in Richmond and you decide you want to go down to Charlotte or up to the New England area. Chick-fil-A started down in Georgia and they came north, but they were always afraid, remember, to go up into the New England area and New York City area because of their conservative focus. But they did it, and they were actually doing extremely well right now. So Chick-fil-A is growing geographically. Five Guys is growing geographically pretty significantly, but In-N-Out Burger, is not. I mean, they're growing geographically, but nowhere near at the rate of a lot of their competitors. And then there's product market diversification, which is essentially both. So that's the type. So when we think about more around diversification, you have a single business, which essentially is a low level of diversification. So when you think about a single business, just think of McDonald's. McDonald's tried to diversify by getting into Boston market and Chipotle many years ago, and then they sold both of those off. So McDonald's is really a single brand, and they have diversified geographically, and they have done some innovation in terms of products, but not doing much. So it's more incremental along the way. Dominant businesses where you have additional business activity that's pursued. So that's like Google. Used to be just search, and now you have a number of areas underneath it. You have related diversification, and related diversification is like a Johnson and Johnson. That's all in the medical arena of sorts. Some of it's over the counter, some of it's pharma, some of it's devices, and where we have constrained, this essentially means that at the top of the brand, that all the sub brands share the competencies of the master brand. That's constrained and linked, is that some businesses will share the competencies. So Berkshire Hathaway, let's go back to Berkshire Hathaway. Berkshire Hathaway, there, if you look underneath and you see all of their sub businesses, you have Fruit of the Loom, and then you have Dairy Queen. And so what are they sharing from a competency standpoint? And Warren Buffett has said at the top, he didn't want to have anything up at the top. Go to their website, look at the Berkshire Hathaway website. Looks like it was made by a 10-year-old. They are a bank essentially up there, and the only competency that they're going to share is the wisdom and experience of Warren Buffett. And so really what Berkshire Hathaway is unrelated diversification. It's a conglomerate of sorts, and really none of the businesses share competencies of sorts. So when you start to diversify as a company, you get to a certain point, you got to figure out, how do we want to do it? Berkshire Hathaway, Warren Buffett made the decision that if we find a company like Dairy Queen, and we determine that there's a good moat, there's a good competitive advantage, and it's sustainable, we'll buy it. But if we're also fishing for a new acquisition, if we find the idea of a product like menswear, where men are always going to, I would think, need t-shirts and, underwear, boxer shorts and stuff, then let's go out and buy that too. And people are going to need paint to paint their homes. Let's go out and buy Benjamin Moore. So, but again, at the top, because it's unrelated diversification, they're not sharing any of the competencies. So these next two models, I really want you to take a deep breath and think through them, because what happens when a company decides not to put all their eggs in one basket and they're going to diversify? So they've got to figure out, how are we going to diversify? Do we want to diversify? Do we have a lot of resources at the top of the organization? So think about Warren Buffett for a second. He's brilliant. They got a lot of financial, but I think they got like 15 people, 20 people in Berkshire Hathaway. I mean, maybe not that few, but it ain't going to be much more than that. So they don't have a lot of stuff at the top that they're going to share with Fruit of the Loom, or they're going to share with Dairy Queen or Geico or NetJets, or, the candy company, the construction companies. So, but there are companies who are going to use their resources at the top. They say, we're great at customer service. So can we leverage what we're great at, what were our capabilities, and move into another industry that allows us to do that? So at UCrops, we were known worldwide for customer service, and it was that way long before I got there. And they said, well, how can we leverage it? I wonder if banking, customer service is important to banking. So we diversified into banking, and we were able to use our focus on customer service that was actually better than most banks. And it helped us get to $1 billion in assets, like in less than 24 months. It's pretty crazy. So when we moved from the supermarket industry to the banking industry, we use a resource-based approach to growth. So resource-based approach to growth is when you're leveraging what you're great at and simply pointing it to another industry. And then you develop a strategy that best allows you to do that. And the strategy usually is going to be, we're going to build it ourselves, or we're going to make it, or we're going to buy it from somebody else who knows, what they're doing and how they've done it in the past. And then we'll share our resources and capabilities to make that happen. So the resource-based approach to growth is, you determine your areas of significant and differentiated strength, and then the competence within your brand. You look for opportunities in the marketplace that match up, and then you establish the strategy that allows you to leverage that. So, and typically, again, the strategy is, you're either going to build it yourself, make it yourself, or you're going to buy it from somebody else that wants to sell it. So that's a resource-based approach to growth. I mentioned Berkshire Hathaway. They use an IO approach to growth. And essentially what Warren Buffett and his team will do is, they'll study the external environment, and they're going to look for opportunities in industry where there's high potential for above average returns. And then they go out and they acquire the assets and use the firm's strengths, its developed or acquired assets, to implement the strategy. So in essence, Warren Buffett will say, we want to get into men's underwear. There's Fruit that we think we can make a lot of money at it. Oh, by the way, Fruit of the Loom wants to sell. We're going to go buy Fruit of the Loom. So that's how he's gotten into all these different companies. It's called an IO approach to growth, and companies will use an IO approach to growth in many respects, and Berkshire Hathaway uses it exclusively. But some companies will use both IO and a resource-based approach. When Amazon decided to buy Woot and Zappos, both online retailers, they were leveraging their resources, skills, and capabilities. So buying those companies was a resource-based approach to growth. But believe it or not, when they bought Whole Foods, brick and mortar is very, very different. So that's an IO approach to growth. So they wanted to get into the brick and mortar business, and so they decided to actually acquire Whole Foods by doing that. So you find opportunities that are ripe for financial potential. You determine the strategy that allow you to penetrate that industry, and then you establish and execute a strategy that allows you to create capabilities. So those are the two primary approaches to diversification. So let's do our case first on a company called Danaher. Danaher is what we call a serial acquirer of diversified industrial manufacturing businesses. So one of their brands is here in town called ChemTreat. They keep a low key, presence in the market. But Danaher has a whole bunch of sub-brands, and they fall under those four categories: professional instrumentation, medical technology, industrial technology, and tools and components. So even though it's diversified at the master at the top, up there at the top in their corporate office, Danaher has a real good group of skills, capabilities, and competencies. And so what they're going to do is they're going to focus on the acquisition and restructuring of acquired businesses. And they're going to do these five things. They're going to look for the diversity. They're going to establish a philosophy and value set that's coming from the top. They're going to then send in their teams to improve productivity. And then they're going to improve quality, cost reduction, and innovation. And the beauty of it is they've got so much cash on hand that they're going to make these acquisitions with free cash flow. And so we'll be talking more about acquisitions, later on. Here's another one, Illinois Toolworks. They're also a serial acquirer, diversified industrial manufacturing businesses. Look at this, they got 750 businesses worldwide. So Illinois Toolworks, if we were right now at Purdue University or Indiana or Illinois, everybody would know Illinois Toolworks, but just like we know Capital One here in town and Altria and Dominion here in town. And so what they do is they actually go in and they look for smaller, low margin, mature industrial businesses. So that's an important consideration. So this would be maybe like your, mom and dad, or let's say your grandmother or father had started a engineering business or a product business, let's say 30 years ago, 40 years ago, and they put their heart and soul into the business, and they decided to cash out on that business. And so they might call ITW and say, ITW, we are interested in selling. They've been successful over that 30, 40 years, but what ITW will actually do is come in, they'll buy them, and they don't like huge acquisitions. So this might be a 50 or 100 person organization. And when you say low margin, that's because they're in the mature section of the industry. So price, things are just really getting harder and harder to make a good margin. And what ITW can do is they can come in and they can leverage their capabilities and restructure it and make it more profitable. So when we think about Danaher, we think about ITW too. Ain't the sexiest businesses around. We hear all about Alphabet, Google, and Amazon and Microsoft and all that stuff. But these types of businesses are the heart and soul in many respects of our economy. A little more about ITW. Well, they were founded over 100 years ago. So we think about diversification allows them not to put all their eggs in one basket. And, they're focused on, specialized industrial equipment, consumables, and related service businesses. So it's a pretty cool business in terms of how it's structured. If we break down ITW's revenue by segment, all right, this is from 2020. Hadn't seen their 2021 numbers. I actually got this Saturday over the weekend trying to update this deck. You see automotive, construction, food equipment, polymers and fluids, et cetera. So right now they're automotive, and OEM stands for original equipment manufacturer. So this whole move into electrification as well as autonomous vehicles I don't know for a fact, but it certainly could be a disruptive driving force coming into this segment. And given the fact that it represents 20% of their revenue, they may be trying to figure out what do they need to do about it. So right now, going in and doing a strategic review for ITW, I think would be extremely helpful for them. They may even be doing scenario planning around that regard. What's also going on in their construction division right now with supply chain and inflation. The question is, are they passing on the additional pricing that they're having to pay from their the companies who supply them, and then are they just eating that, or are they passing those increases on to the customers? Or if, given the fact that they are in construction products, are they in the early stage of the supply chain? So they're dictating pricing right now. Either way, I would tell you that probably ITW is experiencing a higher level of power of supplier, given the fact of where we're at right now. So this is pure, look at this as pure diversification. This is a good thing. Look at that, how even this is, but they got to figure this automotive OEM stuff out. So if you run a business where 80% of your revenue, or maybe even 50% of your revenue, is coming from one customer, it's very dangerous, extremely dangerous going forward. And the diversification in that regard means that you're going to diversify your customer base and industry base, so you're more not reliant on any one industry at a time. So again, when we go back to the idea around the pastel and driving forces, et cetera, what diversified companies think about is that, well, we might be experiencing disruption in automotive, but we're safe in construction or safe in food equipment. What's so interesting about today, in today's world, is COVID came in and had a disruptive impact on a lot of different industries, some negative, some positive, but now supply chain shortages are having an effect on lots and lots of industries. So, and we're going to still have a hangover from COVID, for quite a while. I was just reading an article in the Wall Street Journal before class to catch up on my reading. And it's pretty much seen that the pandemic is going to become an endemic virus, meaning that we're just going to be living with it, for quite a while. And we're going to be managing it through, the folks who choose to get vaccines. And I wore a face mask today. When I went out, had to go to 2 places, made the decision to wear face masks, and I'm all boosted up. My issue is I don't want to be a carrier and bring it home to my daughter's house with her 8-week-old baby boy and her 3.5-year-old son. I do not want to be responsible for giving them the virus. So I'm making a choice, even though I'm not worrying about myself right now. I mean, I'm boosted, had it 2 weeks ago, so I feel like I could get sick. I mean, my best friend from elementary school just got COVID. He had 2 shots. He had the Pfizer shot, and he was out for 10 days. I mean, he said he couldn't imagine what it would have been like to have it without his vaccination. So it's going to be there, and we're just going to have to figure it out. Here's Berkshire Hathaway. I went out and just did a quick screenshot of their brands. So you see Acme Brick Company, jeweler, Benjamin Moore, automotive, direct insurance company, energy. You just work your way down, Boat US. If you're out on the bay and your boat breaks down, these guys come get you So I mean, it's like AAA for boats is really what it is. Jewelry, just work your way down. Clayton Homes, which is interesting. Duracell, I don't mention that much. And Geico and Hertzberg Diamonds and Kraft Heinz. That's through a partnership that they have. John Manville, NetJets, so See's Candies, so Pampered Chef, even NetJets, so incredibly diversified. And so at any given year, I mean, the idea is that 5 or 6 of these brands could be in the crapper and not doing great, but his hope is that five or other 6 are doing so good, it's making up for the brands that aren't doing good, and the rest are hopefully generating a good level of return for him. So again, at the top, Berkshire Hathaway uses an IO approach to growth, but they expect to get a return on their investment. So if they buy a company for $1 billion and they're going to use free cash flow, sometimes they might go to the street. The money's been so cheap that a lot of companies, even though they had the cash, they've been going to the street for dollars. But they want to get a return, just like the sushi bar. You want to get a return on your invested capital, and you're going to try to get it as as quickly and as safely as you can. So vertical integration, is very closely related to diversification, and ultimately, the what we call the source of value creation. So vertical integration, which I'm going to talk about in just a sec, can lower costs, has the ability to improve quality, can facilitate, because now you're controlling it. So it can facilitate scheduling and planning, facilitating investments, securing critical supplies and distribution. So this is the value creation support, but it can also create a cost. So if you don't know what you're doing, or you do a bad job, it can increase your cost. It can actually reduce your quality if you don't know what you're doing, or reduce your flexibility if you don't know what you're doing, or increase potential for legal repercussions if you don't know what you're doing. So the vertical integration is where you actually own an element of your supply chain. And under related diversification that I talked about, we said economies of scope, economies of scale. The financial economies could be through restructuring, leveraging internal capital markets. The coordination and the influence costs can also be a negative. And then unrelated, it's just the idea around financial economies through restructuring, internal capital markets, and then the influence costs. So the influence costs really can go back to what does it take to ultimately create the diversification, as well as those costs afterwards. So let's dig in deeper to vertical integration. So vertical integration it's a strategy, and it's a supply chain strategy. And so for those of you who are in supply chain, I'm sure this is something you've studied in great detail, but you own an element of your supply chain. Usually when you're talking about a manufacturer, they're going to have multiple suppliers. And in the case, let's say, of Patagonia does produce product, but it doesn't produce the product themselves. So it's almost a branded marketing company of sorts, because it outsources all of its manufacturing. So the only thing that actually Patagonia makes is its surfboards. Everything else is made all around the world, and even domestically. So usually each member of the supply chain or segment of the supply chain is producing a different product or service, but ultimately they're combined to satisfy a common need, ultimately for the customer. So it could be backward, or upstream vertical integration, meaning the brand owns its own inputs, or forward or downstream vertical integration means the brand owns activities closer to the customer. So I'm going to talk about Walmart. owning its own dairy. So, so when we think about Walmart owning its own dairy, it used to get its milk from another company that made it. And I don't know who that was. It could have been Borden's or it could have been Dean Foods, but they would call one of those companies and say, hey, we need 100,000 gallons of milk. And, here's what we're going to pay you. And then they'd get the milk. They'd send the check to Borden. Let's just say it was Borden's. Um, so, so that's upstream. That's backward. But then, when we think about, let's say Borden's, let's say Borden's, because they lost the business when Walmart decided to vertically integrate and own its own dairies. Borden's could say, we're gonna buy our own supermarket chain, so we have a place that we can send this milk to, or we're going to build our own dairy stores so we have a distribution point. That would be downstream vertical integration. The closer you get to the customer, forward or downstream. So, but the question becomes why? So Apple is actually vertically integrated and is making its own chips now for sure its MacBooks and desktops, and I think for its iPhone, but I'm not sure on that. But they are for sure vertically integrated, and they made the decision to do this before the supply chain shortages. So this, to me, again, when we think about Tim Cook being a strategic leader, this is the anticipation potentially of problems occurring. I think what he was probably feeling is that the manufacturer of the chips was also selling the chips to Tim Cook's competitors. So it was reducing his ability to differentiate, particularly in terms of battery life. But you do it to either reduce your cost footprint or differentiate yourself from your competitors. And so, because vertical integration usually represents an IO approach to growth. Why do I say that? Let's just use Walmart as an example. Building and producing milk ain't nothing similar between that and Walmart running a supermarket. Manufacturing milk is like night and day. So, but they decided they could reduce their cost footprint. I don't think they did it to differentiate the quality of their milk. They might tell us that, but I'm not sure that's really the case. But they absolutely did it to reduce their cost footprint. And that's an aligned strategy. That's an on-brand strategy. Walmart does it to reduce their cost of doing business, and then they're able to pass those savings on to their customers, which then allows them to be more competitive against their competitors like Kroger and Aldi, et cetera. When you decide to vertically integrate, you have to create an expectation for the new entity. Are you expecting it to be what we call a profit center? So the dairy will actually make money in addition to Walmart having the milk cheaper in the stores, or do you just want to break even? And I don't know what Walmart decided. Sometimes manufacturers just say, look, just break even. We'll make all the money in the retail environment, but don't lose money. Because if you lose money, then we're not going to return on our investment. So, but it's really difficult to pull it off. I mean, you have to figure it out, and you can lose money. You can get real cocky, and you can lose money along the way. So vertical integration is a really significant strategy for companies to focus on. So Walmart and Kroger both bottle their own milk, and they have shooken up the dairy industry, and Albertsons as well. So what happened when Walmart opened up this milk plant, dairy, or Borden and Dean Foods both filed for bankruptcy within 4 or 5 months of Walmart doing it. So Walmart building its own milk plant and then opening it up was such a huge disruptive force for those two brands. They filed the bankruptcy because Walmart has so much power in the marketplace, and so they had to go into bankruptcy, and they're trying to figure out what they want to do. So will Apple disrupt when Apple finally gets all those chips into its MacBook and it's vertically integrating that? Will that have as much of a disruptive impact on that industry as Walmart has had on the milk industry? I don't think so. But what it will do is it will help Apple increase its battery shelf life. And I know for all of us, that's a pretty big issue. On Wednesday morning, I'll be with a client for 3 hours, and I'll be using my MacBook for that. And it's a 2016, 15, 16 MacBook. I can't remember. But I will make sure that the battery will be fully charged by the time I leave Monday morning. And so that's a significant thing to me, and that makes me feel good that they want to do that, and they feel like that is a key reason for doing it. So when we think about vertical integration, this is where we walk in. We walk into a Kroger, and we buy our milk. So we know Kroger has their own dairy right there in the middle. And then the product, the milk, will get shipped to the Kroger store through trucks that Kroger owns as well. And then you have the cows out there who are producing the milk. Now, owning farms, milk dairy farms, that is another level of competency that neither Kroger nor Walmart really want to get into. I know Walmart doesn't own dairy farms. I can't tell you that Kroger doesn't, but the way Walmart has jumped in is I think they're receiving milk from, a whole bunch of dairy farms that within 100 miles of that dairy. And then, of course, you have your feedlots, et cetera, that feed the cows. So I have a cousin named Jim who lives in upstate New York outside of Syracuse, and he's got 1,000 dairy cows on his farm. That's what my two of my uncles were dairy farmers growing up when I was born and raised in upstate New York. And I used to go spend a couple weekends or weeks every summer at their dairy farm, getting up at 4 o'clock in the morning and milking the cows and stuff. But anyway, he has a relationship with a dairy in New York City. So all his milk is shipped from his farm, put in those cylinders that you see on the road and shipped to New York City. So a lot of these dairy farmers have a relationship with Walmart and Kroger, et cetera, now that they're vertically integrated. So, this is the way it works. And companies might just be retail and they rely on partners for distribution, for manufacturing, et cetera. At UCrops, we had our own stores. We didn't have our own dairy cows, but we had our own beef cows. So we had a relationship with a guy named John Kluge, and it was called ProMart Beef. So it was, we'll get into this with the equity joint ventures and strategic alliances and stuff. And it gets really complicated in the world of beef production, but it was an idea we had that was well ahead of its time and ended up failing. We just couldn't figure out how to leverage it in a way that our customers really wanted it. So you see raw materials is stage one, is stage two, then the components and the intermediate goods, and then they're moved to stage three, which is the final assembly and manufacturing. So this is Foxconn Stage 3 for Apple. They've got Foxconn making their iPhones, and Foxconn is also making their MacBooks. Interestingly, Foxconn has bought a manufacturing site for a new electric vehicle company that's going to be producing trucks, and they sold Foxconn the facility, which is somewhere in the Midwest. And so Foxconn is coming to the US to be the manufacturer of some of these smaller electric vehicle startups. And this is not reading about this much right now, but Foxconn coming in is a major threat to the UAW. And we're hearing now about the strike with John Deere. I wouldn't be surprised. I don't know when the contracts are up for the large automobile manufacturers, but we're starting to see a trend in the unions taking a bigger role right now. And this is going to be an additional disruption in our supply chains. They've been striking Kellogg's, Mondelez that makes Chip-Ahoy cookies and stuff. And then you have your marketing and sales, and then your after sales service and support. So the iPhone is made in China. It comes as an import, and then those iPhones go into the Apple stores as well as into the Verizon stores and AT&T stores, T-Mobile stores, and they're sold here. So Apple is actually vertically integrated on the downstream side because it's got its own Apple stores. And then you go back for service to those Apple stores, or you deal with it online. And in many regards, you have these small Apple stores. There's one down on Main Street that I'm thinking of going to upgrade one of my older Apple desktops. So if we think about Apple, then design is made by Apple. The manufacturing is Foxconn. Here are some of the others. And then marketing sales. You have Apple here, but you really should put in, as far as I'm concerned, you could move up AT&T and Verizon up into this area, but this slide has it down here. So it's an interesting process as you think about it. So we got Walmart. We know Walmart is trying to diversify. They've got their Sam's Club stores, which are not growing. They're actually declining. You got their Walmart.com, which is growing. You got their Walmart stores. Their supercenters are growing, but not much. You got their smaller format, they're closing. Their discount stores are closing. Their neighborhood markets are closing. They got their money center and credit card. You now have their manufacturing. And if this milk thing works, they're going to open up their own ice cream plants and cheese plants and stuff. I think that's fairly obvious. Then you have their international. But in 2020, their fiscal 2020, and for those of you who aren't into accounting or finance, fiscal budget is a budget that doesn't fall in line with the calendar budget. So back in my day at UCrops, our fiscal budget started August 1st. And the reason is for us was that, the holiday period is huge in retailing, and you're just dealing with so many other mixed moving parts. Last thing you want to deal with is budgeting during your biggest time of the year. So we moved the budgeting to the summertime, August 1st to July, the end of July. But anyway, Walmart for 2020 amounted to about 559 billion US dollars. So it's a big company. I'm sorry, this slide is old. Forgive me. I'd looked Saturday to see if I could find a newer one. But the reason I want to show you this, and this is 6 years old, is when you look at their merchandise. So if you look at those bottom two slides, charts, you look at the grocery and consumables amount to 50, these are for Sam's, 57%, and then grocery 56%. Why is that significant? Remember going back, Walmart, after the recession of 1991, 92, they did extremely well. They said, we're going to be the nation's largest food retailer by year 2000. And so they started to diversify. And what they did was they ended up moving from their traditional discount store to the super centers. And then they put a lot of food in their neighborhood markets, which were about 45,000, about the size of a Food Lion, et cetera. But so they restructured their formats to enable them to do that. But you look back at 15, well over almost 60% of their business is coming from the grocery and consumables categories. That in itself is diversification. Think about Apple. Apple started as desktop, then they moved to portable, then they moved into portable music devices, and then they moved into the smartphone. And smartphone has been a huge driver of profit for them, the most significant driver of profit for them for quite some time now. And so this is a perfect example of why you diversify, and then it's so important to do that. So I picked this slide up. So if you look at their acquisitions, we'll talk more about acquisitions and our next chapter, but our next module. But you got Jet and Flipkart, and they've already sold off ModCloth. That didn't work. Hey Needle, Shoes.com, Moose Jaw, Parcel, Bonibus, Eloquy. So Bonibus and Moose Jaw are very differentiated, as was ModCloth. And so, they're buying these smaller retail brands, online retail brands, and most people don't know they're doing it. And so I mentioned earlier about what Google did by starting Alphabet. It'll be interesting to see if at some point Walmart decides to rename itself, because it's so focused on price and convenience that the name itself, the reason that Starbucks renamed itself and changed its logo from Starbucks Coffee was to give itself permission to diversify into other areas. So it'll be interesting to see if Walmart eventually does that. They've got a lot of these partnerships. Lord & Taylor, which is kind of interesting. They were all brick and mortar. They shut down, and now they've reemerged all as online. So right now there's a partnership. Part of me believes that Walmart might try to buy Lord & Taylor. Right now it's just a partnership, but we'll see. So that's my other strategic intuition coming out. But you see they've gotten out of some of their international areas. They had actually thought about doing streaming video, but and invested in Voodoo, but they got out of that. And now, of course, they're testing delivery and shelf scanning robots. Walmart is going to have to focus more into innovation, particularly around knowing that there's fewer people that want to work in their stores. So this is their dairy, and we've talked about that store. Here's their Q4 21 annual growth. So again, it's fiscal. So it's already started its new fiscal year. I should have gone back and said, so it probably ended. This was out. So I found this over the weekend. So I bet you they ended their fiscal year probably end of August or end of September, one or the other, probably end of September, maybe July. But it's they're doing really good, guys. Walmart is done really, really well. And this is same store sales. So this does not account for any new store development that they did during this fiscal year. Wall Street loves to look at same store sales. If you're driving, and some of this is inflation without question. So inflation was fixed at about 2-3% for a long period of time. This very well could be, particularly in their last 2 months, 4% of that could be inflation, but they're not generating double-digit growth. So this is actually a little bit lower than Wall Street forecast for them, but it's still good for the supermarket industry. And of course, now they're moving into this area. Online will continue to be a major focus for them. And what's interesting about this is that many people who did not want to go into Walmart because of the anxiety of the big store and the craziness of being in there and the shopping cart traffic patterns and people banging into each other and stuff. So what Walmart has been able to do is attract a customer that normally would have shopped at Wegmans, maybe. And but they're getting some of their products at Walmart, so they don't have to go into Wegmans and just deal with all the stuff that they might. So something might have to. So this is all diversification. I had mentioned to you that they had considered going into a streaming service to rival Netflix and Amazon. Very, very different. Again, streaming and so they had this voodoo thing and they backed out of this now. So they're not moving into streaming video. So this is a really significant slide. If you want to diversify, you got to really say, okay, we're just not going to throw pixie dust at it. We're going to figure out how we're going to do it. So along the vertical axis, you have what you're really good at. What are your core competencies? And you have your existing core competencies, and then you have potentially new core competencies that you have to build, develop, create. And then along the horizontal axis, you have the existing markets that are out there. These are existing industries. And then you got new industries that are emerging. So let's first look at the left side. So if you look at Five Guys, you look at In-N-Out Burger, you look at Chick-fil-A. So you have existing market. Burger restaurants been around forever. Chicken restaurants have been around forever. So these are not new industries. Essentially, they have what makes them really good. We know what core competencies are. And so it's an existing market. You got your existing core competency, and you're right here where it's light blue. You're essentially going to leverage your core competency, which you're really good at, to improve your current market position. So what do we know about Chick-fil-A? We know Chick-fil-A was great at operational excellence. Well, they doubled down on it, and they even took that to another level with their drive-throughs by having double, triple drive-throughs. Pretty crazy. And so Five Guys, it just continues to get better at buying their potatoes and buying their, wherever they're getting their beef from, their, the tomatoes, the lettuce, their peanuts. They're just going to keep trying to get stronger and stronger in that area. If you move up into existing markets, right, but developing new competencies, you could say Walmart was here for two reasons. One, they built a competency for manufacturing, and particularly as it relates to milk production. But you can also say that they had to figure that out for their online retailing as well. So Walmart was not a first mover into online retailing. We know Amazon was, and a lot of other companies followed Amazon into it. But Walmart displayed core rigidity. They didn't want to do it. They displayed cognitive dissonance. They were in a paradigm, but they eventually realized they had to do it. So Walmart, without question, has now developed a core competency in online retailing, but it took them a long time to do it. It took them a much shorter period of time to figure that out for milk production. On the right side, if you go down to the bottom right, you have new markets. So here you're redeploying and recombining core competencies to compete in markets of the future. So what's a market of the future? The market of the future for the automobile industry is, how do you get energy to an electric vehicle? It has to be recharged. And so, green energy. How do you leverage these wind farms out in the Atlantic? So what Dominion is doing now, it's really redeploying, doubling down on their current core competencies to compete in markets of the future. And then on the top, these are brand new core competencies to create and compete in markets of the future. So these are new. Apple has to do that for if they're going to get into car manufacturing. What they're finding, what's taking them so long, is car manufacturing is just so much different than building an iPhone or making a new computer or portable music device, but also for streaming video. So every organization has to really think this through and decide what do we need to do from a core competency standpoint. Another area of geographic expansion is geographic expansion. That's where you're essentially moving from point A to point B. And so, of course, Sweet Greens, In-N-Out Burger, Milk Bar are all growing geographically. McDonald's had jumped in. They've got over 39,000 worldwide locations right now, which is crazy. Of course, many of those are franchised, but there are many corporate as well. So the 5 things that you have to understand when you grow geographically: 1, you got to understand your business model. So you got to determine the strengths and limitation of the business model, including your IP and trademarks. So if you're planning on leaving Richmond, Pure Culture Consulting, my little consultancy, I had to spend $6,000 when I first opened up to protect my name, Pure Culture Consulting, anywhere in the United States. So if it was Pure Culture Laboratory and it was a biological lab, that probably could happen, but there's no way a company could open a Pure Culture Consulting and do the things that I'm doing in Utah unless it was me growing to Utah or California. So you got to understand that. You got to plan the expansion, which is where's the ideal geographic site characteristics and location. And a company can have a core competency in this, right? So one of the things that I think Chick-fil-A we had talked about it, is their whole site selection, the franchise, picking the franchise person, that sort of thing. And that's not easy. Performance, determine what the financial expectations and the timetables to get a return on invested capital, managing the expansion, developing the capabilities to expand, and then managing growth, which is being agile to respond to market response, whether it's positive or negative. Target opened up a store 5 minutes from here right after the big Great Recession. And there was supposed to be a huge amount of homes and apartments built all in the area around my property, and it just didn't happen. And so Target had to recalibrate, the lack of density that was going to keep their store from achieving its full potential. And what we also know is Target tried to go to Canada with 100 stores, and they failed miserably. So as good as Target is, they couldn't grow to Canada and failed. Take a look. This is one of my favorite little heat maps here. I could not get it updated to, excuse me, 2011 or 2021. But this, of course, is Walmart. Walmart opened in Bentonville, Arkansas. You saw it where it was in the 70s, and then see how it's growing. It's just they were just growing outside, from their market area. Then they continued to expand. This is when just about they said, all right, these are all the traditional discount stores. And then they had some new stores. Interestingly, see how they stayed out of New England area. So they stayed out of states that had a high propensity for unionization. They did go up into the, Northeast, but they even stayed out of Michigan to a certain degree. And so then, boom, by year 2000, they are now the nation's largest food retailer. So it's a great example of geographic expansion, staying within your sweet spot and growing. Now they're up here, but they're not doing well up in the New England area. Here's one of my favorite brands, Chicken Fiesta. So he is just starting out. He's right here. This is my little store, the one I love to go to. And this is the one down by VCU. Then there's another one. I went online just to check, and he's pretty much staying with the 4 stores. I guess there's a pretty big Hispanic population down in the Colonial Heights area, but he's even broadened his customer base. I mean, I love Chicken Fiesta, and if he wanted to, he could go to the street right now and get some investment dollars so he could scale his business. But that gets back to vision, guys. Remember, Walmart said it wanted to be the nation's largest food retailer by year 2000. This dude is happy right now with controlled growth. He's got 4 stores. I imagine this store and this Chicken Fiesta took forever to open up. From the point I saw it first sign, boy, it took probably a good year, 12, 14 months, 16 months. So he's just very thoughtful and deliberate. There's no question in my mind there's room for a Chicken Fiesta in the Mechanicsville area. So he could easily have 5 stores, and then where does he go next? Does he grow north? Does he grow east to 64? How does he grow? Does he franchise? Does he license? What does he do from an overall growth standpoint? Some of you know Sugar Shack. They were up here in Richmond. They went to Northern Virginia. I don't know if I went to Tidewater or not, but they actually opened a shop down in Cocoa Beach, and see it's closed now on the bottom in the middle of the state of Florida. So going back to the whole idea around trademark and IP, there's a sugar skincare, there's a sugar factory, here's another Sugar Shack, Sweet Stack Shack, Sugar Rush, the Sugar Shack spelled different, Sugar Shack up here. It's a great name, it's a great brand, but ran into a lot of IP issues or trademark issues, I think. And so henceforth, that was a big problem. They closed that down. So from a restructuring standpoint, this is you over diversify. And you say, we got to get out of some of these areas. They're not performing the way we want them to. So you reorganize and you divest your business units. You help refocus. You leverage your core competencies better. I'll talk about the Boston Consulting Group tool in a sec. And then each category warrants a different strategy. So General Electric in 16, as an example, decided to sell its appliance business to a Chinese home appliance manufacturer. So if you get a GE toaster or a GE refrigerator, you may think that is owned by GE up in, and I don't know if they're in Connecticut or where they are now, but the Chinese company actually licensed the brand, and it's able to do that for many years. So it's still being sold as GE, but it's actually not made by GE or owned by GE. So I'll end the day by talking about this slide. And this was created by the Boston Consulting Group. And it's a way to really look at your portfolio and decide what do you want to do. So let's look at the cash cow bottom right. So cash cow is a business unit where its earnings or profits are very high. It's not being disruptive, so they're very stable. Your cash flow, the cash that it's spreading off is high, it's stable. So with Boston Consulting Group is, man, milk that cash cow, hold that cash cow. If you go to the left, this is these represent your sub brands that are what we call dogs. In this case, their earnings are very low. They're very unstable, but yet the cash flow is still relatively neutral or negative. And so I think when we go back to the bathtub metaphor, we think about Kmart. Kmart fits into this And I think it's, I don't know how they do it, but I think it's all about real estate for Kmart. And so that's why the cash flow is at least neutral in that regard. And so, the whole idea is strategy is just to continue to harvest and or divest. And so when I say harvest, just let's get every bit of profit that we can out of it, with the idea that eventually get rid of it, divest or shut it down. If we go back to the top left, these are question marks. So in this case, the earnings are fairly low, could be unstable, but growing, but the cash flow is negative. So this could actually be a company who is in a market that's still somewhat unstable. It's in where there's a lot of disruption going on. So maybe you can invest your way out of it. And if you get more market share, you could maybe turn it into one, a star or cash cow. So here it says increase market share or harvest or divest. So here you're not quite sure what to do because there's still uncertainty in the industry. And then, of course, on the right side, these are your growing stars. Your earnings are high, you're stable, growing, but the cash flow is relatively neutral because you're still investing in growth. So any one of these could be one of your sub brands. And again, going back to my old world at Ukrops, when I left, we had 26 stores. We probably had three dogs who just we couldn't invest our way out of them. It wasn't going to happen. Then we had another 3 or 4 that were question marks. We had probably 10 that were cash cows, and then we had others that we really felt like had a potential. So we were, out of our 26 stores, we were really generating huge cash out of maybe 6, 7 stores. And so we had to eventually decide to shut down some of the stores. But it's a reality of any business that's around, that you have to take a look at what you're doing, how has the world changed, and what do you need to make the business stronger as a core by exiting some of your